Hi, Clint Coons here with Anderson Business Advisors, and in this video, I am going to discuss lending and limited liability companies. Now, when it comes to LLCs in lending, this can be a particular problem for many individuals who are looking to acquire property. And what I'm getting at is it has to do with underwriters. I don't know how many of you that are watching these videos now have been down that road before where you've created LLCs and you go in to apply for a loan and you're using traditional financing and the underwriter gets your packet and they don't know what to do with it. And so they just throw up all over it and send it back and say to the broker, we can't help this individual. I know this because I've been there myself with my own tax returns. And so what I'm going to share with you are some things I've learned over the years of investing in real estate that where you have asset protection, tax planning, and lending, where those all collide and they can create problems for you in growing your business. Because at the end of the day, we want to make sure that you're able to maximize your portfolio, grow it as fast as possible. And you don't need underwriters to stymie that because they don't understand what it is you're doing or how you're structured. Because in my experience, a lot of underwriters out there, they're not coming out of college at the top of their class. Some of them don't even go to college and they have not yet taken courses to become familiar with taxation or business entities. They're great at putting numbers into boxes, but they can't think outside of the box, and that can be a problem for you. So let me just show you some things that you need to be aware of. Now, one of the strategies that we teach a lot of times is to protect your investable cash. That is, create a limited liability company in Wyoming. So you have your Wyoming LLC here, and this is where you're going to put your cash. And you're doing that for asset protection purposes. I want to get the money out of my name. So if I get sued individually, that money is not available to my creditor. Now, this can present a problem for you when it comes to financing real estate, getting loans on mainly residential, not so much on commercial, but more so on the residential side. So if you know that you're going to go out and you're going to buy a piece of residential real estate and you're going to use traditional financing, that means you're going to close in your own name. Or even if you're not going to close in your own name, you're going to close in a limited liability company because it's a portfolio lender. And you plan to put down 20%. Okay, that's what you're going to be putting down to buy this property. Well, if I have say I had $160K sitting up in this LLC, and I'm looking for property in the $80,000 to $100,000 price range, I'm looking for investment real estate that falls within that price range, then you know the most you're going to need to put down is probably about $20,000 if you find a $100,000 piece of property. So what you should do then, if you have this structure set up, which I highly recommend if you're a real estate investor, you have your investable cash protected, you're going to want to take out a distribution out of this LLC of $20K. The $20K represents the 20% down you're going to need on a $100,000 loan. So you're going to want to take that $20K out and put it into your personal checking. Okay, get that into your personal checking account. Okay, and you want to do it 2 months in advance. Okay, that's very, very important you do this. It's got to come out 2 months in advance of you actually getting that property tied up under contract. Why? Well, it comes down to seasoning of funds. So when the underwriter or the broker asks you to submit the information for the underwriter, they're going to put together a loan packet for you. They're going to want to see 2 months of bank statements. And if your down payment needs to be $20,000, they expect to see $20,000 in your bank account. If they don't see the $20,000 in your bank account, they're going to want to know, where is that money coming from? Is it a gift? Is it a loan? And if you tell them it's coming from an LLC, then they're going to want to know, well, why is it coming from an LLC? And you're going to say, well, that's where I keep my investable cash when it's not being deployed. And that's all of a sudden going to create heartburn for them. Because remember, they like to put people into boxes. You no longer fit into their box. Let's say you have this LLC set up as a disregarded LLC, which is the way my LLC is set up and how we set them up for the vast majority of our clients. So it doesn't have to file a tax return. They're going to want to go to the IRS and they're going to want to find a tax return associated with that LLC so they can verify that it's yours. And you tell them it doesn't file a return and they're going to look at you and say, how can that be? It's a limited liability company. It has to file tax returns. And you're going to say, but no, it's a disregarded LLC. Never heard of it. Literally, I've been down this road before, so I just want to forewarn you. These are the types of individuals you're going to be working with, and they're going to fight with you that this should be filing tax returns. And you're going to tell them the IRS won't accept tax returns. Well, how do we know who the owners are? How do we know there aren't more owners? Well, the answer is if there were more owners, then it couldn't be a disregarded LLC, because disregarded LLC means there's only one owner. If there's more than one owner, then it has to file a tax return. Get it? They don't. So rather than put yourself through that heartache and stress of having to work with these individuals who do not understand you and your complicated life and how you put things together, pull the money out 2 months in advance. It's the simplest way to do it. Now, when they look, they're going to see that the money is in your name. So this was a situation where you're buying residential real estate, you're using traditional financing. How about if I'm using commercial, or I'm going to be buying something in the name of the LLC? Well, in that case, we're going to do a little different. What we're going to do is set up our LLC that we're going to make the offer in. So set up this LLC right here. Get your bank account set up in it. And if I knew that I'm going to need, let's say, $100,000 for my down payment up here, then what I would suggest you do is you take the $100,000 out of this account as a distribution. So you pull that down to yourself, distribution, because you're the member. And then you're going to contribute it to this LLC. So that would be a contribution. All right. And again, do it 2 months in advance. All right. Always make it 2 months in advance of making the offer. And the reason being is that they're going to ask for 2 months of bank statements for that LLC as well. And we want to see that money in the account on those 2 months of bank statements. So they know that that money's been in there and it's been seasoned. This is very, very important when you're putting these structures together. If you were going to be using a self-directed IRA or QRP to buy property in an LLC, again, same principle. If there's financing involved, which you should never do financing in a self-directed IRA because it's taxable, but if you're going to use a non-recourse note, again, get the money into the LLC 2 months in advance. So when it comes to financing in LLCs, it can sometimes be problematic if you don't move the money the right way ahead of time before you're making your offer, so they can see where those funds are coming from. Another thing to keep in mind that I just touched on when working with underwriters as well, all LLCs, I like to have them run through a holding company, as you've seen in my other videos. Let's say that I have multiple LLCs set up for my real estate. This is my rental real estate. Then I like to create this holding company right here. This is typically going to be Wyoming, or it could be Delaware if I'm dealing with commercial. And then I'm going to have all of these LLCs owned by this one. This one down here, I like to treat as a partnership. All right. I want it to file a tax return, and it gives me a K1. So I want to get that K1 onto my 1040. Again, this is something that lenders or underwriters, when they look at a tax return for a real estate investor, it's going to give you a greater degree of credibility with your investing when you're pulling it through a K1, your rental income, versus Schedule E, page 1, where you just have a bunch of properties listed there. Because it indicates to them that you've taken your investing to another level and you've made it more of a business. And so that translates, again, into their little box scenario for them. So I prefer to run it this way. So lending can be complicated. There's no doubt about it. With Dodd-Frank, Barney Frank first screwed it up back in the day, and then he tried to fix it, and they went overboard. And I know how frustrating it can be. I deal with it myself. Every time I go for a loan, I just cringe. I keep my loan packet available on my computer. I know everything they need ahead of time. And still they come up with more information and say, well, we need to know how much you spent on wine last month because that's a new calculation we have. So anyways, don't let the frustration get you. There's tremendous opportunities in real estate. Interest rates are low. Go out there, take advantage of it. Just make sure you're setting yourself up the right way so you can close without any hassles. My name is Clint Coons with Anderson Business Advisors, and in this video, we talked about lending and limited liability companies.